Okay, good afternoon everyone, and welcome to the Forager Funds webinar version of our 2017 Roadshows. This is Alex Larkman from Forager Funds. So firstly, a quick run through of the webinar session today. Steve will be doing a presentation on the Forager Australian Shares Fund, which will be around 20 minutes. This will be followed by an update on the Forager International Shares Fund, which will also be around 20 minutes. Then Jeff Whedon, our CEO, will be giving a Forager business update, and following on from that, we will have an open question time. You can type your questions in during the presentation at any time, and time permitting, we will go through these at the end. So please note that everything you hear during the webinar is general information only. If you're intending to invest at any point, please do seek professional advice. And now we'll pass you over to Steve.
Thanks a lot, Alex, and welcome everyone. As Alex already touched on, we're going to talk Australian Fund first here, and I'm joined next to me by Alex Chevrolet, who has recently joined us to work on this Australian portfolio and has been busy already. We'll bring you into the presentation a little bit later on to talk about some stocks, but just a quick hello. How are you, Alex? Hello, everyone. Doesn't want to say how it is. It's been a few difficult first weeks here. This is a chart showing the Australian Fund performance for financial years since we started. So that first 2010 year is only a part year. Every year up to after that is 30 June to 30 June, and it's been another very good year for the fund. It's the 5th year in a row where the return's been in excess of 10%, and the 6th in a row where we are in excess of the index, and well in excess of the index on average. I'll touch on this a little bit later in the presentation. Obviously the outperformance has been very good, but one of the surprising things for me has been that the returns have been less volatile than I expected. When we started this fund, I promised people that we would try and outperform, but that the returns would likely be very lumpy. And we saw that in the first few years, but the past 5 years in particular have been remarkably consistent. That's more coincidence than specific management on our behalf, and we'll talk about some of the reasons why later in the presentation. On an annualised basis, you can see that last year there at 25.1%, and as I said, very consistent returns, really out to the 7-year and since inception number there now that's almost 15% per annum after all fees and costs. One really important point there is the bottom line on that table, the cumulative return since inception. We talk a lot about the power of compounding. You can really see it start to impact on early investors in this fund here, where if you put in, or whatever you put in on day one, you've almost tripled that initial investment in the 8 years since, assuming you reinvested all of your distributions over time. And you can really see that start to grow. Once you make a 10 or a 20% return, once your investment's already tripled the size, it's growing at multiples of your initial investment in shorter and shorter periods of time. The distribution over the past year was 11 cents. Long-term investors will be familiar with this. We are mostly generating capital gains in this portfolio rather than income, and you should expect the returns to come in the form of capital gains. We work fairly consciously on trying to make sure that those gains are held for more than 12 months rather than less than 12 months, and you can see there at 11 cents. Almost all of it was concessional CGT, a little bit of income there. Franking, you should not expect to be a huge component of the distributions out of this fund, but we did generate 1.1 cents per unit of franking last year, and that was largely a result of Nero and Jumbo paying large fully franked dividends, and both of them paid specials during the year as well. The distributions from this fund, like the returns, should be expected to be lumpy. It is not meant to be an income-generating investment. It's just that when we realise gains, we do have to pay them out, and you should expect that as the returns wax and wane, so will the distribution over time. I spoke in last year's performance report about the fact that we had a good year on paper and we had a good year relative to the market, but that the market's return was actually, I guess, flattering our portfolio returns. And the reason for that was that the large blue chip stocks, the banks and the mining companies in the 2016 financial year fairly dramatically underperformed the average stock on the market. And because they carry such a high weighting in the index, that dragged the index return down. And really anyone that didn't own those stocks, i.e. had a broader portfolio of stocks, was reporting very good relative numbers in that 2016 financial year. The 2017 year has been one where the opposite has been the case. The small and mid-cap part of the market has performed really quite poorly over the course of the year, and there have been a significant number of stocks that have performed very badly. Largely that is a consequence of the stock prices at their highs being way, way too high, and we saw a lot of money actually come out of large cap stocks in early 2017 financial year and invest in the smaller end of the market because they were underperforming. Even stayed old listed investment companies like AFIC and Argo announced, I guess, an asset allocation shift into these small and mid-cap stocks. And really through to August, September 2016, we saw that push up the price of some of these darling stocks to completely unsustainable levels. And you've seen the consequences of that over the 9 to 10 months since. This chart that's up on the screen at the moment is price movements from 52-week highs. And it's a bunch of stocks with market caps greater than $100 million that are pretty widely held in the small and mid-cap space. You've got names there like Vita Group, Reject Shop, Focus, both the telcos actually, Focus and TPG, Shine, CSG, Bellamy's, Billabong, RCG, Certex, Aconex, Main Pharma, Catapult. So this is not to criticise anyone that owned those stocks. We're going to talk about this in a moment. We had a few bombs in our own portfolio. It's just pointing out that the tailwind of the previous year was ahead with this last year, and our relative performance is probably a little bit more creditable for that. Here's the breakdown of our performance by stock contribution. Starting at the bottom of the list there, we did have a couple of blow-ups in this portfolio. Hughes Drilling was actually a minus 100%. The company filed for receivership in September or October last year. It was a bad investment for us, and you can see they're contributing almost minus 2% of the portfolio. And RNY Property Trust, which was once the largest holding in this fund, the share price fell from a high of 35 cents down to the point where we sold it at 5.5 cents. Part of that damage was done in the 2016 financial year, but as you can see on this chart, a lot more damage done in 2017. This is really the main reason that I wanted to point out that I guess the lack of volatility in our returns has been more about coincidence than good management. We've had a couple of very bad performers in this portfolio, and had that happened in a year where we didn't have some very big good performance, it would have been a relatively bad year for the fund. We've had a couple of meaningful weightings in stocks that performed very poorly. What has offset that is that we've had some stocks at the top end of this chart that have performed exceptionally well, and they've offset the poor performance, which is exactly what we expect to happen over time. The point I'm trying to make is that the returns would be a lot more volatile if it didn't happen at the same time, i.e. they happen sequentially. Up the top of the list, ServiceStream was once again the largest contributor to portfolio performance over the year. It's 2 years running for this stock. It's actually something I think we've done a very, very good job over the past few years, is improving our portfolio management skills. We spend a lot of time on idea generation, and I think you can really split the whole funds management job up into 3 areas. There's idea generation, there's research, which I view as the due diligence around that idea generation. So I've got an idea and I think it's attractive, let's do the work to make sure that we're not making a mistake. And then the final piece is portfolio management, and that is around how much of our portfolio do we want to put into this stock. How do we manage that weighting as events unfold in front of us? And what we've done a much better job of over the past few years is having the right weightings in the right stocks and really managing those stocks to the benefit of the portfolio as events have unfolded. And ServiceStream is a really good example of a stock that we could very easily have sold a year ago and not made the gains that we've made over the past 12 months. The stock had already tripled by 30 June last year. We bought it for about 20 cents, did nothing for a few years, and then the share price tripled to 60 cents. And I think we have historically been guilty of this, and value investors are particularly guilty of it. It's very easy to sit there after you've tripled your money and say, look how clever we are, and sell the stock and move on. And what we've done well here is constantly update our numbers and our assessment of the future based on the facts that are in front of us, rather than based on history. And in Service Stream's case, yes, the share price had tripled, but the business was performing really well above our bull case expectations. We had a bear case that the fixed communications or the NBN related part of their business was zero. Our base case was it was going to be worth a little bit, and our bull case was they could get back to earning decent margins in that part of the business. Really, they've exceeded our expectations. The revenue's up a long way, and the margin is well and truly above what our most optimistic analysis was. And it's looking increasingly like, for the next few years at least, that is sustainable. So we made the right call there not to sell that stock. We've obviously reduced the weightings to run up, but we have kept it as one of the larger holdings in the portfolio. And it's added as much to our portfolio this last year. That decision just to hang on to it has added as much as the original work that went into finding the idea and buying it. We're going to talk about Macmahon when it comes to the outlook for the future, but a couple of other stocks worth mentioning there. Jumbo Interactive, the latest quarterly report's got a bit of a rant on this stock about the management behaviour over the past few months. It has nonetheless been a very good performer for us. We think it could have been a much better performer had management played their cards right. You can read the details around that in the quarterly report if you wish. And then a couple of stocks underneath that, NZME and Cardno. Just want to make the point here that neither of those were in the portfolio at 30 June last year. Gareth and I are going to talk a little bit about cash and the power of cash later in the presentation, but as an investor in the fund, over time it's going to be our new idea generation that's going to drive your returns rather than the portfolio of stocks that are in the portfolio today. And I think these two are good examples of that. They weren't even in the portfolio at 30 June last year. We've been able to identify a couple of good new opportunities. They obviously don't all contribute straight away. Sometimes it takes a long time, but in this case, they've both contributed immediately to the portfolio within a relatively short period of time. This slide shows you the current, or the portfolio as at 30 June broken down by market cap. You can see we have a strong bias towards small caps at the moment. In fact, we don't have any stock in the portfolio that's more than $1 billion in funds under management. We will generally be focused on small and mid-cap stocks, but you should expect us to own a larger company from time to time. We have historically waded into and out of that space, and you should expect us to continue to do so when the opportunities are there. South 32 was obviously a huge contributor in the previous financial year. That was a large cap stock, and earlier in the fund's years we owned quite a number of large infrastructure stocks that were big contributors. So we will, can and want to own them at the right time when they're cheap enough, but particularly in I guess a relatively buoyant market like this, it's harder to find those cheap large cap opportunities. So the portfolio is currently biased strongly towards the small caps, and there's a fairly hefty cash weighting in the portfolio as well. It says 18% on this slide at the moment. We're about to talk about some changes over the past month or so that have increased that cash up towards 30% as we sit here today. These are the top 5 holdings as at the 30th of June. We will talk about Macmahon in a second, but I do want to touch quickly on Reckon. Any of you that follow our ASX announcements closely might have noticed that we sold our entire stake in Reckon over the past few weeks or so. I'm actually going to bring Alex back into the conversation here and get him to make a few points about why we've sold that stock, but really you can take that 8%, add it to cash for now. Alex.
Thanks, Steve. So Reckon is it's an accounting software business, and it's the sort of software you might see in a small and medium enterprise. It's sort of Xero and NYB product people are quite used to seeing. Another component of the business is providing practice management software for accountants. The business had a third leg up until a month ago, and that was a document management division. It was actually spun off onto AIM. It's the exchange in London. Now, it's actually quite difficult for Australian shareholders, both retail and institutional, to own an AIM stock. And in that process, the valuation that was determined for the rights issue was actually less than what we penciled in initially for that division. Another interesting point there is the CEO, Clive, his son Daniel, and the Reckon founder Greg Wilkinson actually underwrote a rights issue. Now, their incentive would have been to underwrite that rights issue at a lower price, the lowest possible, and they'll actually end up owning a larger percentage of the equity than they do Reckon itself. The incentives here seemed a little bit skewed towards the spin-off. On the business side, and that's the SME component of the business is really undersold from MyOb, from Zero, and from Insure, who used to partner with Reckon. Insure's really been aggressive on the marketing side of things, and has really now popped up in terms of the number of online users and apps. And then we come to the fourth point. The APS division is one that people put a lot of strategic value in. It provides that practice management predominantly to accountants, and looks after 3 of the 4 larger accounting firms with some form of software. Now, the actual APS strategic business is probably only half of that division as a whole, and breaking that division down at a time seemed that APS business has actually been outlining for quite some time. The other components in that segment are less strategically valuable and deserve lower multiples. So all of that combined to an erosion of the margin of safety. Hand back to Steve.
Yeah, so I think there were a couple of oversights on our behalf from an analytical perspective, a loss of confidence in the management team, and we don't really think this stock is likely to be a disaster from here, but we don't think it's the opportunity that it was either. So we have moved on from that holding and are looking to deploy that cash elsewhere. One stock we do like over the coming few years is McMahon Holdings, and we bought this mining services company at a massive discount to its net tangible asset backing, and we've always been pretty critical of the industry as a whole, and if you'd said to me 12 months ago we were going to be able to exit this stock at net asset backing, I would have been surprised and be very happy to do so. We've currently got McMahon trading roughly in line with its net asset backing at the moment, and we haven't moved on. In fact, it's one of the largest holdings in the portfolio, and it's another one of these situations where we think that there's been a lot of change over the past 12 months that has made our, I guess, analysis of the value of the business change quite a bit as well. Alex, do you want to talk about some of the, I guess, the key tenets of the valuation here?
Thanks, Steve. So, as Steve mentioned, the NTA, the assets on a per share basis that McMahon's currently has is probably about the current share price. There have been some substantial changes, and one of the biggest ones was a contract for mining services. Now, McMahon's obviously helps miners to mine their deposits, and a particularly large contract, one they won recently, was with AMNT to mine the Batu Hijau mine in Indonesia. Now, that's a very large contract, and what it does is it actually helps to diversify the business away a little bit from Tropicana, which is one of their their largest domestic contract. One of the reasons behind that win is new management that recently came in. Mick Finnegan, who actually came up through Leighton, which is now part of Cynic, and then spent 3 years at Mars. Mick seemed very well regarded on the Indonesian side, and I think that might well lead to continued ability to win work in Indonesia from Mars. And bringing it all together, it seems the business now is close to about $1.1 billion of revenue, if you include the new contract in. And reasonable margins seem to be close to 8% on that business. So you're talking about $80 million of earnings before interest and tax. At a $380 million million market cap, that gets you to an earnings multiple of only about 6 times at the moment.
Thanks for that, Alex. Alex has joined us over the past few months as a very keen, enthusiastic and experienced value investor, and you're going to see lots of new ideas from him in the portfolio over the coming years. We'll just finish off that McMahon discussion with a picture of me looking at a big hole in the ground. There you go. Gareth has some quote, he'll bring it in later, about a gold mine is just a big hole in the ground with a lyre on top, something like that. One more stock I'll touch on really quickly here, CTI Logistics. Again, it's in the latest quarterly report, so you can read the details there. It's a West Australian-based logistics company that we've recently added to the portfolio. Very small, very liquid. I used it as an example of the type of investment that we can make with this, what we call a permanent capital vehicle, where we as the fund manager don't need to worry about redemptions or applications. We can invest in these illiquid businesses, and this chart that you've got up here is how this company has grown its book value per share over the past 14 years. One of the key signs, I think, of long-term wealth creation for shareholders, and they've done a wonderful job of it, and we're backing to continue doing that into the future. Finally, on the Australian Shares Fund, I did want to touch quickly on the market price. This trust listed on the ASX in December last year. It's now a fixed number of units on issue, and those units trade on the ASX rather than us issuing new ones and redeeming them at net asset value. That grey line that you see on the bottom there is the net asset value per share. Just for people that aren't familiar with it, we add up the value of all of the holdings in the portfolio and the cash every day, and we divide that by the number of units on issue and estimate the NAV per share. It's an estimate, I guess, of the intrinsic or underlying value of this vehicle, and you can see the yellow or orange line at the top there is the market price, and you can see it's been trading at a healthy, or some would say large premium to NTA, really since it listed, but particularly so over the last few months. Look, our job is to manage that asset pool that we have, to grow it and earn returns on it over time. We are not sitting here every day stressing about the market price. I do know it's causing some investors frustrations though. To the extent that we do our job really well, it's likely that this vehicle will trade at a premium, but my advice to people is, I think if you be patient, that premium will wax and wane over time, and you may get better opportunities to invest in the vehicle. It's worth remembering that we gave everyone who was an investor in this vehicle before it listed the chance to redeem before ASX listing, and some people who wanted to get out took advantage of that. So at the moment, there's just not a lot of we advise people to be patient. I'm going to boot Alex out of the hot seat now and bring Gareth over to talk about the International Shares Fund. Just while I'm doing that, we've had a few, I guess, questions about the sound quality. We're trying to get a bit closer and talk a bit louder, so if you could let us know if that is improved, that would be great. Welcome, Gareth. You're a name that's familiar to a lot of investors, but you've just relocated back from Europe to Australia. How are you settling in?
Yeah, I think we'll have a house by the end of the week, hopefully. That's a rental, by the way.
Joining the No Homeowners Club here in Sydney. Here's the same chart that we had for the Australian Fund, for the International Fund, and it was our best year since inception for the Forager International Shares Fund last year. That's both absolute and relative to the index, and the first 3 years in particular there had a fairly strong currency tailwind. This past year we've had a currency headwind, in fact, so the return would have been better had the Aussie dollar not appreciated against other currencies there. You can see 2016 was a relatively bad year for both the index and for the fund. We were slightly better than the index, but it was really that 2016 year that set us up for the results of 2017, and we'll talk about some of the details there as we get into this. On an annualised basis, it was a 27% year. We've been slightly over 30, except for the currency impact. Since inception, return there a very healthy 17%. Worth pointing out there, though, that is only a little bit over 1% per annum ahead of the index. Obviously, we've been paid fees as well, so the gross fund performance was better than that. But We do have higher relative expectations of ourselves. We run a relatively small fund, we're a small team and have a lot of flexibility in our mandate. We want to deliver results well in excess of the market over time. The market itself is really not helping us at the moment. It's been a very strong 4-year period for global equity markets since we started, and that makes our life much more difficult. Here's a quick chart on the currency movements over the course of the year. I sat on I guess had a number of media appointments this time last year on panels where people were asked their view on the outlook for the Australian dollar. My comment that I had no idea got laughed down, but everyone else was unanimously of the view that the Australian dollar was going to depreciate further from 70 cents to the US dollar. It has in fact appreciated and quite substantially against other currencies around the world, including the yen and the pound. And since July, we've seen further US dollar weakness against the Aussie dollar, but particularly against the euro as well. That does have an impact on us, not just at a portfolio returns level, but also at an underlying portfolio level. We have quite a number of European exporters in the portfolio that don't really want the euro appreciating. The distribution last year was a large 21 cents per unit. We don't typically own a lot of dividend-paying stocks in this global fund. In fact, the general level of dividend payouts globally is much smaller than it is in Australia because of our franking credit system. We do, of course, try and minimise non-concessional CGTs, so stocks that we hold for less than 12 months. You'll notice that this year's distribution does include 5 cents of non-concessional. We had a couple of stocks, Sotheby's in particular, that we owned that rallied very, very strongly within a very short period of time of us owning them. And we always weigh up the benefits of holding on to the end of that 12-month period against the risk of the share price falling from there. In Sotheby's case, we formed the view that we wanted to sell it. In any case, in hindsight, we would have been better off because it's rallied about 30% from there. Moving on to the list of contributions for the International Fund. You can see the top of the list there, Lotto 24. I'll pass over to Gareth to talk about some of the other European stocks, but really quick insight into this one, and I guess into our idea generation process. This is a stock that wouldn't have turned up on any filter. As far as we know, it wasn't owned by any other institutional investors or on any blogs. It is a online retailer of lottery tickets in Germany. It's a very similar business model to the ASX-listed Jumbo Interactive, which we've owned for quite a few years. And in fact, we came across this stock through Jumbo. They announced they were going to launch a German business a few years ago. They told us they wanted to be number 2 or 3 in that market. And they effectively told us that the number 1 player was almost certain to be this German company called Lotto 24 because they built the business before and had done it a few years prior and then been shut down by the government, but had been reissued with marketing licenses to run their business there. So it was the CEO of Jumbo that tipped us off to the fact that there was this German company highly likely to win in that large and lucrative German market. And it has actually turned out to be the case. We were lucky enough to find out that Lotto 24 was listed and that it was very cheap, and the share price there is up from less than €3 to more than 9 as of the latest trading. I'll bring Gareth in here to talk about a few more of the European holdings and other stocks that have done well for us over the course of the year.
Thanks, Steve. Our second most important investment in terms of returns last year was LN. This is an Italian company. On our roadshows through various cities over the last few weeks, Steve has been drumming in the idea that we are interested in anti-narrative stocks. So narrative stocks, ones that have a good story, are very popular these days. And a lot of our best ideas are ones where the story doesn't quite work or it stinks a bit. But we have enough confidence looking through the numbers that we can find value. The surprising bit with LN was that it actually has a very good story and it was available very cheaply 18 months ago. LN make lasers for medical and cosmetic treatments and sell those right around the world. Things like facial blemishes and tattoo removal. And the underlying industry is growing very fast, sort of in the vicinity of 10% per year. And LN has a wonderful name in the industry and makes really good products. And it was available 18 months ago at a price below 10 times earnings. And we had a lot of confidence to load up on the stock at the time. That's subject subsequently tripled over the last year and a half, and has significantly improved added to returns. And we have lightened up our position quite significantly over the last few months and own a little bit still.
Gareth, another stock on there that's in your neck of the woods that we've owned for a few years now and has been a good contributor to portfolio performance is Car Traffic Com. What's helping there, and what do you think about its current prospects?
If you're an Australian driver, you will likely have a toll tag in your car for when you go on toll roads, and there's probably a 70 or 80% chance that is made by Hutch. They also make the transponder, the equipment that goes on the gantries over toll roads that talk to that little device in your car. So they're the ones basically responsible for your toll bills. And we bought that stock when it was very cheap, 2.5 years ago. They had some truck tolling contracts in Europe that were wonderful cash-generating businesses that underpin the valuation. They also had some problems in other areas. And the last few years has just been about that stock price catching up with the reality of what we thought we could see a few years ago. It's not as cheap as it once was, and the position is no longer as big as it was. It was once our largest position. It's been a good contributor, but it's not a cheap stock today.
There's one more stock on that list that is a relatively small bar, but it should be a much larger one. I know you're very angry at me for it. You want to talk about that?
Flughafen Wien was this is the airport in Vienna. They also own a majority stake in an airport in Malta. And it's a kind of an orphan stock. 40% of it is controlled by various authorities, government authorities in Austria. 10% is owned by staff, so that's 50%. And then an Australian investment group, IFM Investors, took a 14% stake over the last few years. So at the time we bought it, it was slightly under €2 billion market cap, but the free float was less than 200 million. I estimated we bought that stock on a 7 or 8% free cash flow yield, which is outstanding for a high quality airport with a lot of growth ahead of it. And the market's called up over the last 12 months or so and marked that stock up about 50%. So I'm a little dirty at Steve, but I forgive him.
Just one point worth noting as you look through this slide, a lot of people ask me how a small team can cover the whole world. We don't even really try to do that. And when you look down the list there, you'll see a number of Italian stocks and a number of Austrian stocks, and these are tiny stock markets in terms of the number of companies that are listed on them. But we've done very, very well because we have specific and deep expertise in those markets, and we're really not trying to cover the whole world. We're trying to know the few places that we do invest extremely well, and you can see in this chart that you can generate plenty of excess returns as long as you know what you know extremely well. Quickly on the US, there's a lot of stocks up there that we made 30 and 40% returns out of over the past year. And my view is it's a difficult market in the US, and this is a function of that. We've done well. Kevin's done a great job. It's a very competitive place. There are literally thousands of mini Warren Buffetts running around over there trying to do what we do. And it's a hard place to generate excess returns. Kevin's done a great job of finding us these stocks that have delivered us 30 and 40%, but we're typically buying things at, I guess, a smaller margin of safety and selling them once they hit what we think is fair value. One exception to that is another missed opportunity for us. It's the last of the actual stock bars on that list, Malibu Boats down the bottom. This is a manufacturer of high-end wakeboarding boats that has a very big brand name here in Australia and in the US. It's been a good business over a long period of time, and it traded down during a bit of a small cap sell-off in the US to a level where it was trading at 12 or 13 times earnings. And Kevin did a lot of work on the stock, wrote it up for us, and we started buying it as the share price jumped up on us. And we stopped buying the stock because we were waiting for the price to come back, and ended up with, I think, 50 or 60 basis points or 0.5% of the portfolio in that stock when we really wanted it to be 3, 4 or 5%. Unfortunately, the share price didn't come back. It doubled from there to $28 and should have been a much bigger contributor than it was. This portfolio is a lot more liquid than our Australian fund portfolio. Again, you should expect that to continue to be the case. We We have, I guess, access to opportunities that are larger in market cap that have the same amount of, or same degree of under research and lack of coverage that we have here in Australia, up into that 1 to 2 billion market cap range, really. And particularly in Europe, it's not really an equities culture over there, and you get larger businesses, sometimes family owned, so the free float might be much smaller than the market cap. Opportunities to buy much larger businesses there than we do in Australia. And we even have a couple of stocks in that portfolio that are more than 5 billion market cap. Lloyd's and Alphabet are the two biggest contributors to that. We can want to and do own some of these stocks. We get some criticism for it, but you guys were looking for an edge at the smaller end of the market. We have a lot of cash at the moment. We think these two businesses in particular are outstanding businesses that are going to generate us much better returns than cash over a long period of time. And we're really happy having some of our portfolio invested there while we look for and wait for and find opportunities at the smaller end of the market. You should expect us to move out of those stocks like we have over the past few years and into smaller stocks when opportunities arise. There are also businesses that we're really happy owning in the interim. These are the top 5 stocks as at 30 June last year. I'll touch quickly on the largest of those, Just Group. For investors familiar with Challenger here in Australia, this is a similar business, but in the UK, they sell retirement annuities. So you go to them and you may invest something like $100,000, and instead of giving you a fixed amount of money for a fixed period of time or an interest rate, they will actually guarantee you a payment for the rest of your life. So as an example, if you're 65, that payment might be something like £5,000 on a £100,000 investment, and they take the risk on how long you live. So it's a combination of insurance and investment product. Just Group's niche is that they offer medically underwritten annuities, and this is where they give people differential pricing based on how long they think they're going to live on a wider group of factors than most annuity providers are doing. So instead of asking you 5 questions about how old you are and where you live and whether you smoked or not, they'll ask 200 questions that get a lot more information about the life that you've led, and this is one part of life where you don't want a good price because they're offering better prices to people they think are not likely to live as long. It's a stock that we're able to buy at a big discount to book value. The share price has been quite strong lately, but we think we're still going to do reasonably well from here. Just, I guess, another general comment on our shift in Europe over the past few years. I might just get you back in here quickly, Gareth, to talk about this. I guess shift away from the higher quality growth into some of the more cyclical stocks.
Yeah, as we said earlier, it was only 18 months to 2 years ago we were buying really high quality businesses in places like Italy at 10 or even less times earnings. And that is something we'll do all day if we get the opportunity. That sort of segment of the market is now shut down. That part of the financial crisis has ended. We are still finding opportunities in generally illiquid but more cyclical businesses, often somewhat riskier businesses. We like those opportunities. We want them in the portfolio, but it's not they're not things that we're happy to put in big weightings into.
You may have seen Ubi Banco, which is an Italian bank, on this list of top 5 holdings there. That's one of those cyclical businesses that we are quite excited about. Italy scares people and the word bank scares people. You put the two together. It can be quite a scary investment, but we're really impressed with the progress that's being made in the Italian banking system and the wider Italian economy, actually. So we're at the right price. We're quite happy with some exposure to that in the portfolio. And one other holding, again in the latest quarterly report, Cementir. It's another Italian listed company, but most of this company's business is outside of Italy. They're a cement company, and cement can either be a very good business or a very bad business depending on how much competition you have. Cost of transporting cement is very high. If you have a geographic monopoly, you have a very good business. If you have competition, particularly in a shrinking market, you can have a very bad business. We think we're buying this stock for the value of its assets outside Italy, but its Italian operations are an important piece of the upside for us. This chart that's on the screen at the moment is Italian cement production over the last more than a decade, and you can see there that it's more than halved. This is something I don't think everyone's aware. There's been a recession in Europe. The magnitude of it in Southern Europe has really been devastating for a lot of people. And this is a chart about cement production, but it just shows you one industry there, construction, that's more than halved. You know, here in Australia, if we had a 5 or a 10% contraction, it would be a huge event. So just a sign there of the magnitude of the, I guess, depression that part of the world has been in. And we think there are some encouraging signs of recovery there. So another cyclical business that is going to be an important part of the portfolio over the coming years. Just a general comment, I guess, on the investing environment out there. This is a chart of the VIX index, which is a measure of volatility. It's on the US market. It can really be applied globally. Go back and look at our own NAV per share. It hasn't moved around much at all over the past 6 months or so. This lack of volatility is really an issue for investors like us. We want volatility. We want the ability for share prices to move around a lot, because that's what gives us the opportunity to buy stock prices that are cheap. The one good bit of news for investors in the international fund is the exchange rate has obviously been strong. It's giving people an opportunity to invest globally. We are holding a lot of cash, and this is in both portfolios. I know some investors have expressed concern at that over the past few weeks. We've done our roadshow, but it really has been a very good thing to have over the years, and something that has added a lot of value to the portfolio. Gareth answered a few questions at the roadshow, and I'm just going to get into touch on this point here as well.
Our analytical team has differing views on cash holdings, but I think we're all in agreement that we view cash as a weapon. My personal opinion is it's fine if we have 20 or 30% cash weightings in the portfolio some of the time, as long as every now and then that cash is being put to work. And we've seen that over the last few years in our international fund. Now, at 30 June 2015, we were more than 25% cash. And then the next 2 months, July and August 2015, there was significant volatility and fear in the market, and our cash weighting fell to around 10% and largely held there. And 6 months later, January, February 2016, there was really quite severe panic, especially around China-related issues. Our cash weighting was down to 3%. And then another 3 or 4 months later, we were back up north of 10%. What's really important there is not the strategic use of cash, but we bought in that time, we bought South 32, which went on to subsequently double for us. We bought Sotheby's, which nearly doubled for us before we sold that too soon. We bought a big position in LN, which subsequently more than tripled. And the question is, would we have bought as much stock in those if we had to sell other things that were looking cheap at the time to buy these stocks? And I think the answer is probably no, or not in as much volume as we did. So having that cash there as a weapon has allowed us to buy some of the most impactful stocks over the last few years.
The most common question I've had over the past 8 years is now a great time to invest or not? And I think Gareth's point there is that we can and do move very quickly. And really my answer to that question hasn't changed for most of that period. There have been a couple of periods where we even sent an email out at one point saying this is a good time to invest, but the reality is it's been a very costly thing to not be invested over any of that period of time. And I reiterate to the people asking that question all the time, you as an investor should be thinking about what's the right asset allocation for you. What do I want in Aussie equities, global equities? How does Forager fit in with that? We've said right from the start, and I still think it's the case today, we are typically an adjunct to a blue chip portfolio, perhaps an index fund, whatever it is at the core. We're the bit that sits to the side of that and is supposed to generate you the excess return. If you get the asset allocation portfolio right, if you allocate some of that to us, you leave the stress with us and the job with us of picking the right stocks and getting the portfolio fully invested at the right time. We are going to give Alex 5 minutes to collect some questions here. Jeff Whedon, our CEO, is going to chime in and just talk about a business update while she does that. Just a quick introduction. Jeff joined us in February last year to help us with the listing of the Forager Australian Shares Fund. He's done such a good job and we've all got on so well that he's now the CEO and an equity holder in the business, and He's taken a lot of the stress of the business side of things off the investment team's hands, and he's doing a wonderful job. So here he is. Hi, Jeff.
Thanks, Steve. Hi, everyone. It has been an eventful few months here at Forager. It's been enjoyable and challenging, and it's been a very good thing for me personally. Look, I looked at investing in Forager before I joined, and I've got to say, particularly with the listing project and having the chance to meet investors and to see the business behind the scenes, I've only been impressed. So it's, I hope you get the impression out there that we very much place investors' interests first, but I can vouch for the fact now on the inside that is very much the case. I don't want to take too much time talking about the business side of things, but you would appreciate we're a small business, and we have a talented investment team, and but nonetheless we have some key man risks. So the business is being as systematic as it can be about improving, I guess, our sustainability and addressing some of the key man risk issues. My role covers a few areas, but first being, I guess you'd say, business resilience, and really the primary responsibility here for me, and Alex also, who does works very hard on the business side also, is giving Steve and the team the most focus they possibly can have on the investment side of things, and we've attempted to take as much of that from him as absolutely possible. We've done the things you'd expect the last 18 months or so, but particularly around high quality compliance, operations and other risk management systems being improved and enhanced, and reflecting the greater amount of money that we now manage. Growing the team is the other thing we're looking to do. We've done that through time, but again, with more money to manage, it's really important we have the right team. We've got some redundancy and backup for Steve, and obviously that we find people that complement the existing skills and talents that we have in the investment management team. So hiring the right people is really important for us at this point in time. It's a demanding work environment. Beating the market consistently, certainly we are setting out to do over time, is something that doesn't happen 9 to 5. We need people that are as committed to this business and committed to our performance as the existing team is. We've got to make sure it's a competition for talent out there. We've got to make sure that it's an attractive place for people to learn and work. We're really going to focus on those things, and along with providing the right incentives for staff to produce the right sorts of outcomes for investors. And in terms of business sustainability, it's very important for this business that we have the right sorts of investors. Historically, this business has had and has long-term investors. It's allowed the team to take a long-term view on investing themselves. So it's very important from a sustainability perspective that as we grow, we continue to attract the right sorts of investors, and that's a definite focus of ours. All of this, we hope, leads into fund performance. So doing all of those things on the business side, we hope will help improve outcomes and maintain the sorts of outcomes you've experienced to date with Forager. Growing the business is also part of what we need to do. It's part of, you should be assured that we're working towards being and have a sound financial footing. It's one of those things, again, we're a small business, and it's one of those ways of ensuring that your investment with us is on a sustainable footing. When we listed last year, we had about $250 million under management. That's grown to about $340 million. You can see that on the slide there. Of that, 150 million is in the International Shares Fund. It's a fund we think we can grow initially to $300 million with the existing team and resources in place, but longer term, perhaps a multiple of that. So it's very important that we do that. There is ultimately an end game here. We don't want to be a large fund manager. We don't want a large group of people in the investment team. We think there's a sweet spot there that provides for good, very good performance, but also puts the Forager business on a sound financial footing. It's also very important as we grow that we maintain what is very special about Forager, and the transparency and the forthright approach that you've experienced with Forager to date must be and remain a part of what we're doing. That's about it for me. You always give us lots of feedback. Please continue to do so. It only helps build our business, and we're very appreciative. Thanks very much.
Thanks, Jeff, and thanks to the rest of the team. Now we'll move on to some questions. So we've got a handful of questions. The first one I can quickly cover off. Someone has asked, is the seminar in Perth going to discuss the same topics as today? So it will cover the same topics, but you'll have the chance to actually meet the team. So myself, Jeff, Steve, and Alex will all be there in Perth tomorrow. So next question is from Helen. How do you set exit strategies each time you purchase a stock? I.e., do you have any criteria for this?
That's a great question, Helen, and we do, I guess, when we buy it, sit there and say we're buying this for a discount to what we think it is worth, and generally if the stock were to immediately trade at what we thought it was worth, we would sell it, and that's the exit strategy. Is this stock no longer provides us with the margin of safety that we required when we invested in it. The reality in practice is that a lot of things change between when you buy a stock and over the ensuing years, and it's very important to constantly update your valuation of that business, and that may be up and it may be down. So we may sell a stock that hasn't gone anywhere, like we've done with Reckon, simply because we think we got the investment case wrong or the investment case has actually changed. And vice versa, like I talked about with Service Stream earlier in the presentation, sometimes the stock can go up a long way and you can decide that you don't want to sell it or you don't want to sell all of it because your estimate of the valuation has moved a long way as well. So it's constantly asking this question about margin of safety. Is the stock still worth less than, sorry, is the stock still trading for less than we think it is worth?
Thanks, Steve. So moving on to the next question from Lars. It's stock specific, and that is, why is South32, being an ASX company, held in the International Fund?
Thanks for that question, Lars. We made an exception with South32 to put it into the international portfolio because it is listed on multiple exchanges around the world, i.e. we could have bought it on the London Stock Exchange or the South African Stock Exchange. It also has a global business, and it was really it's a large liquid stock, so there was no competition there for liquidity. And we really made the decision that we were hurting the investors who are in the international fund from not buying this stock. There are in fact no mandate restrictions that stop us owning Australian stocks in the international portfolio. We're fully conscious of the fact that most of our clients are choosing international or Australian, but in the case of South32, it's a truly global business. It's listed on multiple exchanges, and we thought there were enough reasons there to hold it in the international portfolio. That may happen again in future, so don't be completely surprised. We will never invest a particularly significant percentage of that global fund in the ASX market.
Okay, thanks for that, Steve. So moving on to the next question from David. You're very much bottom-up focused. However, do you pay any attention to overall market valuation levels relative to historicals, i.e. price earnings, CAPE, etc., when determining your allocation to cash?
I've seen a lot of people twist themselves in knots around trying to worry or forecast the overall market, and I think it's a very dangerous habit to get into, and one that I haven't seen a lot of evidence that people are particularly good at. So we really do stick to the bottom up. Can we find opportunities that meet our our hurdle return requirements. And generally that's been pretty good at also meaning we've held lots of cash at times when the market has fallen, and that's just simply because we're not finding lots of opportunities out there. So you can look at our, I guess, overall cash weighting as a broad reflection of the overall market. When it's expensive out there, you'll see us hold lots of cash, and when we think it's cheap, you'll see us hold very low levels of cash.
Thanks for that question, David. I've got a quick one from Daniel. When you disclose your returns, is this net of fees? And if it is, does it include brokerage?
So all of those returns are net of fees, yes. It does include brokerage effectively, because the price that we pay for a stock includes the brokerage, and the price that we sell it for includes the brokerage as well. So the returns that you're seeing are including the impediment that comes along with brokerage. So it includes both of those things.
Okay, thanks for that question, Daniel. So next question from Sean. Hi, any thoughts on CSG Limited? I think it's one you've mentioned in your blogs, and it's down 30% today.
I'll touch quickly on this one. It is a stock that we did mention quickly. I think it was actually in my letter in the quarterly report about the downside of being large. It looks today like there are upsides to being large as well, and that we didn't get a lot of the shares that we wanted in this stock when we first tried to buy it. Look, I think at that mid-40s level, this stock is still interesting. They reported this morning and the share price is down about 20%. We started accumulating it in the mid-40s. It very quickly went up to the high 60s, and I think in the high 60s it's getting much closer, or maybe even above fair value. But we haven't had a good chance to go through the results today, but I think if it does fall back into the 40-cent level again, then we'll be having another close look at it.
Thanks for that question. Next one is from Bart, and that question is, I noticed you have Cardno in the Aussie portfolio. Do you view it as a turnaround, or is it another business case to own? Is it impacted by the major ownership by Crescent Capital Investments?
I'll take Cardno too, given Alex hasn't had a lot of time to get his head around this stock. Look, this is absolutely a turnaround story, and the turnaround is now priced in to some extent. There's a US business here that's still earning very low margins. To justify today's share price, those margins are going to have to increase quite a bit. We think that is likely to happen. We think they may get better than is implied by the current share price, but I think it's worth with this stock recognising that we were buying it at 60 and it's currently trading at $1.20. So today's price is very different from the price at which we were enthusiastic about it. On the subject of Crescent, we're actually really impressed with their management of this stock. They have taken a controlling stake. They effectively control the board here. They ran a very good AGM last year. They brought a lot of the senior management team on and gave retail investors access to that management team. They are not spending a lot of time communicating with investors. Some institutional investors see that as a negative. I see it as quite a positive. They're working very hard to get the right incentives in place for this business. So I have been reasonably impressed. They're probably going to want to exit at some point, and so are we. We'll hopefully be able to get that timing right, or I guess use their desire to exit to give us a potential exit from the stock as well.
Thanks for that question, Bart. So we've got one just coming from Brian. And that question is, when thinking about risk management for individual positions in the portfolio, how much of a drawdown are you willing to tolerate? 1, as a percentage on an individual position, and 2, as a percentage of fund NAV.
Thanks, Brian. Our tolerance for drawdown is very high. In fact, a lot of the significant contributors to the portfolio return over the past year were very significant drawdowns prior to that. And we first bought McMahon at 11 cents. I think at one point it was trading at less than 4, and we were still accumulating shares at that point. So we don't have any hard and fast limits around that sort of thing, and we try and be as, I guess, independent of each situation as we can. Is it an opportunity at today's price or not? And what is the right portfolio weighting at today's price? I know Gareth has some thoughts on some tools that investors can use around this type of issue. That I think some value investors, one of the big mistakes you can make is to keep doubling up on something which eventually becomes a zero, and you know, the cumulative results there can be terminal. Gareth, do you want to just touch on this quickly?
Yeah, people use shorthands like stop losses, and even thinking about it in terms for a specific reason, which is the greatest investments you'll ever make are the one where you find an absolute bargain and then it falls 50% and you keep buying. But they're also the most horrendous mistakes you'll ever make, because something falls 50%, you keep buying, it's headed to zero. So there are some tricks. Some fund managers, for example, think in terms of a percentage of the portfolio at a cost basis. So if I might have 7% to play with and I put 4% in and the stock halves, I can put another 3 in, but then I'm done. We don't have any hard and fast rules like that, but we do try to keep that front and center, because we don't want to be doubling down into mistakes, and it is a risk.
Great, thanks for that, Gareth. And I think we've got time for one more question, and this one is from Rosemary. You have no New Zealand shares in the international fund yet. Yet this is a market quite easy to access from Australia. Is this a deliberate policy?
Nothing against the Kiwis at all, I promise. Look, we have I guess a semi-regular look at the New Zealand market. We talked earlier about putting South32 into the international portfolio. There's quite a few dual-listed stocks. I think we could make the same case for something like an NZME that is in the Aussie portfolio that perhaps should have been considered for the international portfolio as well. It is a market that we consider there. It's tiny, and I would say in general it's quite expensive. Certainly the businesses that we've looked at and liked have been trading at pretty high prices relative to what we like to pay. So there's a few businesses over there that are on the love to own at the right price list. Xero is in particular one of those, but there's nothing in the portfolio at the moment. Don't let that make you think that there's never going to be a New Zealand stock in there.
Okay, thanks for that question, Rosemary. And I'm afraid that is all we have time for today in terms of questions, and I apologise if your question wasn't answered. So just to let you know, this webinar has been recorded and we will be distributing it to you in the next couple of days. So thank you very much for listening today, and I hope you enjoyed this webinar. We will aim to host another webinar later on in the year, so please keep your eyes on our website for that. And thanks for listening today, and goodbye from me and the team.